The capital budgeting decision-making process emphasizes cash flows rather than earnings. So that may be surprising because since you've had an accounting course, the idea that profits aren't what you're really after might be surprising. But we've all seen instances or read in the paper of instances where companies manipulated profits. Cash flows are something that are not easily manipulated, in the sense that when you go to the bank and deposit $100 in the bank, that $100 is real. Everybody understands the $100 is $100. $100 of profit, on the other hand, might represent a situation where there are positive cash flows, or it may be a situation where you actually have expended capital or cash in order to generate the profit in excess of the cash that you're bringing in. So profits aren't the same thing as cash flows. Let me give you a simple example, and a very important one. Depreciation is an expense for profit purposes. We deduct depreciation expense, but it isn't a cash flow. You don't write a check for depreciation. You might write a check for salaries. You might write a check for rent. Those are expenses also, but those are expenses that required a cash flow. Depreciation, the cash flow occurred at the beginning of the life of an asset. So somebody bought the asset. There was a cash flow at that time, but the accountants didn't treat that expenditure as an expense. They treated it as purchasing an asset, and then they used depreciation over time to bring the cost into the profit and loss statement. So depreciation is handled very differently for earnings, for accounting purposes, or earnings purposes, than it is for cash flow purposes. It's important in calculating earnings. We have to get rid of it for calculating cash flows. We're going to look at an example here, and we'll go through this fairly slowly. Here we have the cash flows for Alston Corporation. And Alston Corporation has earnings before depreciation and taxes, and also we haven't indicated it here, but also interest. It has earnings of $20,000 before depreciation. It also has $5,000 of depreciation, which is an expense, but it's not a cash expenditure. Okay, it's not a cash flow, but for accounting purposes, it is an expense. So our earnings before taxes are $15,000. Now, assuming, and I'm eyeballing it here, it looks like the tax rate must be 35%, something like that. It doesn't really matter. Taxes are calculated on the basis of the earnings before taxes. So we actually use that $15,000 to calculate a tax amount of $5,250, and that gives us earnings after tax here in blue of $9,750. Having said that, this isn't the cash flow. In order to get to this earnings number, we deducted depreciation of $5,000. So here we're going to add back that same depreciation. Got a little plus there. We're adding that same depreciation back. And the cash flows from this potential project are $14,750. Now, one thing that trips students up frequently is question will arise, well, do I need to worry about depreciation since it's not a cash flow? When I'm doing any sort of analysis, why do I worry about depreciation? Why don't I just ignore it instead of deducting it at the top, adding it back at the bottom? And the answer very simply is that number right there. Right? That's what happens in between. The only step in between here, we deduct depreciation, we calculate taxes, we add back depreciation. We can't get that tax number right unless we deduct the depreciation. The IRS allows us a deduction for depreciation in calculating our taxes. So in order to calculate the tax number right, and taxes are a cash flow, we actually have to pay those with cash. So we have to recognize that even though depreciation isn't a cash flow, it impacts a cash flow, it impacts the taxes. So we deduct depreciation, calculate taxes, add back the depreciation. Now, I mentioned one other item that wasn't included earlier. All right, what's missing in that short little cash flow calculation? We calculated earnings and cash flow. What's missing? Well, interest expense. Interest expense is not included in our capital budgeting cash flows. And you might ask why. Why aren't we including interest expense in the cash flows? The answer is we're going to handle the interest cost somewhere else. And essentially, the interest cost is going to be buried in the discount rate. If you recall, we calculated a weighted average cost of capital for the firm in Chapter 11. That weighted average cost of capital included the cost of interest. Interest expense was included as part of the weighted average cost of capital, and that weighted average cost of capital drives our estimation of the discount rate that we should use in calculating the value or making decisions about potential projects. So we're not going to deduct interest expense, even though it's a cash flow. Instead, we're going to consider not just the cost of borrowed capital, but the cost of all capital, including stock or preferred stock, all of that in the weighted average cost of capital, and so our interest expense is going to effectively be buried in the discount rate. That's the important thing. It's buried in the discount rate, it's not in the cash flows. Now, a reasonable question might be, well, why do we use cash flows instead of profits? So we've touched on this earlier. Why do we not just use profits? Isn't the goal of every firm to generate a profit? And to sort of clarify a point here, let's look at this next little revised cash flow for Alston Corporation. The format is exactly the same as it was before, except now we have earnings before depreciation and taxes. It's still $20,000, so that first number is unchanged, but we have depreciation expense of $20,000, so that our earnings before taxes are zero. This firm, earnings before taxes is zero, therefore the taxes is zero, therefore the earnings after tax is zero. Okay? Earnings after tax is zero. On a profit basis, this project isn't making a profit at all. But notice that after we add back depreciation expense here at the bottom, remember we deducted it here, we add it back here. After we add back depreciation expense, we've generated $20,000 in cash. In other words, our bank balance has just gone up by $20,000. Now, if we were to make a decision based upon profits here, we would probably forgo this and say, well, this isn't a profitable activity, we're not going to do this. But in fact, we're generating cash. We can use that cash to pay dividends, we can use the cash for other activities within the firm, so it clearly makes sense to undertake this with that $20,000 cash flow. So in a nutshell, that's the reason we do it. Cash flows are in every sense very real. They allow you to put deposits in the bank, they allow you to pay your bills, they allow you to pay dividends, pay your interest costs. Profits don't do that. Now, the accountants want us to calculate profits, and I'm a CPA myself. I'm not going to tell you profits are completely unimportant, but they're unimportant, or at least should be unimportant, in the capital budgeting process. So let's talk for a moment about the impact that depreciation has, right? Because there's a paradox here, meaning two different outcomes that don't seem to be consistent. Depreciation expense is going to reduce current earnings. Okay, it's a deduction, reduces earnings. But depreciation expense increases cash flows. Earnings are reduced because it's a deduction, right? It's a non-cash deduction. Cash flows are increased, not because the depreciation does anything directly, but when we have depreciation, we get to reduce our taxes. It reduces taxable income and therefore reduces taxes and increases cash flows. So there's a paradox. Okay? We have depreciation expense, earnings are going down, but cash flows are going to go up. So which one do chief executive officers care about? Well, they should care about cash flows. Having said that, all of the reporting requirements, SEC reporting requirements, are based upon, almost all of them are based on earnings. If you read the papers, you read about earnings per share. And so many CEOs have a concern about short-run earnings per share, and that colors decisions that they make. Which should they care about? They should care about cash flows. And I listed here current cash flows. They should care about the cash flows over the life of the firm, and make decisions on that basis, because you have to pay bills with cash. You have to pay your shareholders with cash. But not all CEOs are farsighted. Some of them are looking for short-term profitability, even if it's at the cost of long-term value. Good ones aren't in that boat.